Deutsche Bank tumbling this morning in European trading. The bank hit by a sudden
plummeted as the cost of insuring the bank's debt against default leapt to multi-year highs,
sparking renewed concern about the stability of European banks. Joining us now.
Deutsche Bank is the 22nd largest financial institution in the world. It's half the size of Bank of America and 7 times bigger than Silicon Valley Bank. So after demand for insurance against the bank suddenly skyrocketed on Friday, people are rightly concerned about whether Deutsche will be the next bank to collapse, especially because it would reflect the fall of a systemically important bank, the effects of which would be felt around the world. So today, I want to talk about what exactly happened with Deutsche Bank over the weekend, why did their CDS prices go through the roof, and what does it tell us about the likelihood of Deutsche Bank failing in the future? I'm trying to hit 200,000 subscribers by the end of the year, so if you can help me out, I'd really appreciate it. All you have to do is go below this video and hit that subscribe button. But with that said, let's get into the video. Deutsche Bank is an investment bank based in Frankfurt, Germany, which was founded 153 years ago in 1870. In 2022, the bank had $1.4 trillion in total assets, making it the 22nd largest bank in the world, which is about half the size of Bank of America and 7 times bigger than Silicon Valley Bank. It's even twice the size of Credit Suisse, which was the Switzerland-based bank that was acquired by UBS after it collapsed last week. Deutsche is also one of the systemically important banks, a list created by the Financial Stability Board to indicate the few banks whose failure could trigger a financial crisis. Or in other words, the banks that we've deemed are too big to fail. Although it's fared better than some, Deutsche Bank has had a tough time since the global financial crisis. Since then, their total deposits have gone from $550 billion to $665 billion, an increase of about 20%. But at the same time, their total assets have gone from about $3 trillion to $1.4 trillion, more than a 50% decline. And while the bank has been profitable in many of the past few years, their $5.9 billion profit in 2022 is still 40% less than the profit they made in 2007. Deutsche Bank had pretty significant exposure to CDOs during the global financial crisis, which was the derivative which fueled the housing market bubble and led to massive losses at a lot of major financial institutions. CDO stands for collateralized debt obligation, and it's a type of financial security that bundles mortgage bonds together to be sold to financial institutions.
This is your basic mortgage bond. All right? The originals were simple. They were just thousands of AAA mortgages bundled together, guaranteed by the US government. Somewhere along the line, these Bs and double Bs went from a little risky to dog shit. When the market deems a bond too risky to buy, what do you think we do with it? You think we just warehouse it on the books? No. We just repackage it with a bunch of other shit that didn't sell and put it into a CDO. This is where we take a bunch of Bs, double Bs, and triple Bs that haven't sold, and we put them in a pile. And when the pile gets large enough, the whole thing is suddenly considered diversified.
Leading up to the GFC, poor lending practices led to a lot of bad loans ending up in these CDOs, and when the loans began to fail, banks like Deutsche had a lot of exposure. By the end of 2006, the problem was so bad that over $500 billion worth of CDOs was being issued annually, and Deutsche Bank was one of a handful of banks that were issuing tens of billions of dollars a year. In 2008, Deutsche Bank lost $5.3 billion, and their total assets were revalued from $3 trillion to $2 trillion. Almost $1 trillion in value was wiped out in a year. Their stock price is still 80% below its 2007 peak, and after falling another 30% in the last few weeks, the stock is now 50% below the bottom of 2009. On Friday, the stock fell 14% during the morning trading session, and it all has to do with another type of derivative used during the global financial crisis, the credit default swap. Just before I talk about what is happening with Deutsche Bank this week, I do want to quickly talk about the sponsor of today's video, the Daily Upside. The financial media landscape is massive. You have cable networks, newspapers, YouTube, TikTok, all throwing sensationalist headlines down your throat, and it can be really hard to figure out what you should actually be paying attention to. Except for TikTok, of course. I mean, if you get your finance news and information from TikTok, then I can't help you. But in all seriousness, a fantastic source of reliable news and business stories is the Daily Upside. It's a totally free financial brief that's sent to your email each morning and covers the most important news and stories related to investing and the economy. It's concise, informative, and witty, and leads to more detailed stories about what's happening in the economy around the globe. There's coverage of corporate news, the economy, policy changes, and investing news, all coming from a team of financial professionals. Personally, I read the Daily Upside's brief every morning to get an idea of what's happening in the markets and to create content like this. I did a bunch of research into the Credit Suisse collapse, which actually has a lot to do with what's happening at Deutsche Bank, and this article from the Daily Upside provided some great insights on the issue. So whether you're someone who works in finance or someone who just wants to get a jump start on finance news, then the Daily Upside is a great way to start your day. It's totally free to sign up, and they send you one information-filled email each morning. Join the huge number of investors who trust the Daily Upside and sign up using the link in the description. On Friday, Deutsche Bank's stock price took a dive, declining 14% in a few hours before recovering a little bit to finish the day down 9%. And it all had to do with the price action around one of Deutsche Bank's other securities. Credit default swaps against Deutsche Bank bonds saw their prices surge 50% in a couple of days. But first, what is a credit default swap? Well, you might remember the name because it's another type of financial security that was used during the global financial crisis. In fact, credit default swaps were the security used by Michael Burry, Steve Eisman, and other investors to bet against mortgage-backed securities such as CDOs. They're called swaps because you're essentially transferring the risk of a security to another party in exchange for a premium. Or in other words, the CDSs are basically insurance to protect against the risk of a bond failing. If you buy a credit default swap, then you will pay out premiums every month to that person who's taking on that risk. And in the event that the bond that the credit default swap is held against ends up failing, then that other party who you made the contract with will essentially pay you out the value of that bond. And there's actually a couple of different ways that people use this type of security. They can be used as a hedge by insurance companies, pension funds, and other financial institutions who lend money to a borrower and want to protect against the risk of the borrower defaulting. But they can also be simply used to speculate on the likelihood of a borrower defaulting, like Michael Burry did in 2007. Since late 2021, these credit default swaps held against Deutsche Bank bonds have quintupled in price, meaning demand for insurance against Deutsche's debt has been rising a lot. And it's pretty simple. Why do you think people would be willing to pay more for insurance against Deutsche Bank bonds failing? Well, it's because the investors believe that there is a higher risk of Deutsche Bank bonds failing. And that concern around the higher risk of default stemmed from the banking collapse that we saw the week prior. Credit Suisse, the second largest financial institution in Switzerland, had to be bought out by UBS last week, Switzerland's largest financial institution. And while Credit Suisse certainly had their own unique problems, there was something that the Swiss government did after the acquisition, which is part of the reason why Deutsche Bank is seeing trouble at the moment and why people are loading up on insurance against their bonds. The UBS acquisition was finalized at the start of last week, where they agreed to buy Credit Suisse for $3.25 billion. And while that might sound like a lot, it's actually 60% below where the stock closed on the Friday before the acquisition. So investors who held the stock to the last day got significantly less than they could have if they sold the stock on the last day. And especially if you compare that value to where the stock was, say, around the global financial crisis, investors who held the stock from prior 2007 lost 99% of the value of their investment. The shotgun marriage, so to speak, happened after Credit Suisse saw an acceleration in withdrawals as a result of panic caused by the US banking crisis. The Swiss bank saw a 40% drop in deposits in 2022 and was told by Swiss regulators that they must make a deal with UBS before the end of the weekend. In fact, Swiss regulators even bypassed shareholder approval in order to get the deal done quickly before the Asian markets opened on Monday. The collapse of a systemically important bank sent ripple effects around the European financial sector. But it was the decision by Swiss regulators regarding AT1 bonds which directly affect Deutsche. Through the UBS acquisition of Credit Suisse, Swiss regulators decided to wipe out a certain type of bondholder even though shareholders weren't wiped out first. AT1 stands for Additional Tier 1, and it's a type of risky bank debt that converts into equity when a lender runs runs into trouble. Typically, when a business collapses, the bondholders will be paid out before any money is seen by shareholders. In this case, the Swiss government violated this hierarchy and spooked investors who held bonds of other European banks, such as Deutsche Bank. This started with the AT1 Deutsche Bank bonds specifically seeing a sell-off, and then it flowed through to the credit default swaps held against some of these bonds, and those premiums shot up significantly. European regulators issued a statement on Monday indicating that bondholders would be paid out before shareholders in the event of other collapses, but it still didn't stop people from loading up on insurance. So with all this said and done, is Deutsche Bank actually at risk of failing? Well, at least so far, the drop in stock price and the surge in the price of swaps seems to be driven by market panic rather than based on any new information about the likelihood of Deutsche collapsing. While yes, like Credit Suisse, Deutsche Bank has had their fair share of scandals and investigations, the business's fundamentals are in far better health than Credit Suisse was when they collapsed. For example, Deutsche has been profitable for 10 straight quarters, whereas Credit Suisse lost money in 7 out of the last 10 quarters. But then again, the oracle of CNBC, Jim Cramer, said that Deutsche Bank is fine, and the last bank that he said was fine was Credit Suisse, and before that, it was Silicon Valley Bank.
Is SVB Financial too? I think the fears were not justified, and it's a very compelling situation. Hey, by the way, long-term private equity and venture capital, they're not going away. Stock's still cheap.
So I think it's pretty ballsy to bet against inverse Kramer on this one. But in all seriousness, just because a few talking heads say that the business looks fine or the bank looks fine and won't collapse, doesn't mean necessarily that it is. And we've got to remember that these are very complex financial institutions, and often the problems aren't obvious even to people who are looking very closely. After all, looking at the stress tests that were done on banks last year, it looks like the stress test wouldn't have even caught Silicon Valley Bank's issue, which is kind of mind-blowing to think that a stress test designed to look at these banks specifically wouldn't have catched a massive $100 billion issue in the financial system. Truthfully, we actually have no idea whether Deutsche Bank or other big institutions are going to face further trouble. And it's part of that lack of clarity, which is likely why the premiums on these credit default swaps are skyrocketing. And it's also the reason why the likes of Steve Eisman are avoiding the banking sector entirely.
All the regulations are probably going to get much more stringent, making the banks much less profitable. And that's not going to be clear for many, many months. So why be a hero? Because you have absolutely no idea what's going to happen. The best you can say is you don't know. And if you don't know, you shouldn't play.
A reminder to check out the Daily Upside. It's completely free and a fantastic way to stay up to date with finance news. Check it out via the link in the description.